There you are. I was expecting you. I'm John Zidar. This is On Top and Hot, and this is the first weekend of March. Now, if you watch my show regularly, you know what I like to do. I like to talk about hot penny stocks. I'm a day trader, and that's what I primarily trade, is stocks under $5. But on the weekends, I like to take the time and share some of my own personal trading insights with you. Information I think can help you get the most out of your trades. And today, I want to talk to you about risk to reward ratios. Maybe you've heard something about it. Maybe you want to know more about it. Well, I'm going to share what I know about it from my perspective. There's a lot of information out there about risk to reward ratios. But as a penny stock trader, I look at it from one point of view, and that's what I'm going to share with you. So let's jump into it. So let's talk about risk to reward ratios. What are they? How can they help you? Well, personally, risk to reward ratios help me by keeping me calm, by reassuring me. You see, a risk to reward ratio is nothing more than a simple calculation to help you determine how much money you're either going to make or lose in any given trade. In other words, you basically know how the trade is going to turn out one way or the other before you even get in. That's reassuring. Now, the reason that happens is you have to answer all the questions before you get into the trade. You have to know what your entry is. You have to know what your target price is for profit, and you have to know what your stop loss is. Personally, I get these by using supports and resistances. Those are the horizontal lines you see drawn on a lot of charts. This is where the price likes to change direction, where it bounces. So personally, I like to put my entry over top of a support. Once it gets over that speed bump, it normally cruises pretty easily to the next resistance, my probable move. I put my target for profit up underneath the next resistance, and I put my stop loss underneath the support that I'm on. I've got all the questions answered for better or for worse. I don't have to make any decisions in this trade. I just let it happen. Now, the great thing about R&Rs is they can help you with your win rate. They can help you win more trades. However, this is the great part about R&Rs. You don't have to win more to profit. Let's say you have a 33% win rate. You're losing 2 out of every 3 trades. You're only winning 1 out of every 3. Well, your portfolio is probably down, losing more often than winning. And you're thinking to yourself, the only way to fix this is to win more trades. That's not true. With a win ratio of 1 out of 3, you can make profit with a risk to reward ratio. Now let's get a couple things straight here right from the start. Nobody wins all their trades. It's never been done. Can't even be done by AI. It's impossible. So quit thinking you have to win every trade. Get that thought out of your mind. Losing trades is not going to break you. Everybody loses trades, and a lot of people are making good money doing it. The other thing you've got to concern yourself with is keeping your eye on the right ball. Most people are focused on the gains. They're trying to get as much as they can possibly get. They're watching the chart to see how high it's going to go, looking for that ceiling. It is that type of thinking that gets most investors in trouble. What we need to be focusing on is minimizing our loss, risk management. Let the wins take care of your profit. When you're playing poker, you're not counting the money as it's going into the pot. You're concentrating on winning that hand. And when you win, you still don't count the money. You just rake it in, ante up, and get ready for the next hand and are concentrating on winning that. It's the same thing with trading, folks. Get your mind off of the gains and start looking at the losses, what you can control, what can do the most damage to you. Most people that neglect risk management end up in the midst of emotional chaos, making decisions in the heat of the moment. Not the best time to be making decisions. So I always like to get all of this out of the way before I get into a trade. I know when I'm going to get out when things go good. I know when I'm going to get out when things go bad. And I stick to my trade plan. Let's take a look now at risk-reward ratios. Think of them as fractions. That'll keep it simple for you. Risk-reward ratios come in all sizes like string. It depends on your personal needs and circumstances and whatever security that you're trading. Your R&Rs can vary greatly depending on what type of security you trade. If you're trading stocks, you're probably going to get some real sweet and juicy R&Rs for profit taking. If you're trading Forex, that chart don't move very much, so you're probably using some very tight R&Rs. If you're trading futures, that can vary greatly from day to day. And options, they've got so much complex information and strategies, it's going to take some very careful computations to come up with your R&Rs for them. But being that I'm a day trader, focusing primarily on penny stocks, this is pretty easy for me, and I'm going to try to keep it easy for you. Now, as I said, risk-reward ratios come in all sizes, but we're going to look at 3. You understand these, you'll understand how the rest of them work. We're going to look at a 1-to-1 ratio, 1-to-2, and a 1-to-3. A 1-to-1 ratio, that is an all or nothing ratio. It's like playing blackjack. You put a $5 bill on the table and win, you doubled your money. You got another $5 bill. If you lose all your money. That's what a 1-to-1 ratio is. And this is used most often in Forex, but a lot of scalpers use it as well. A 1-to-2 ratio means that you're making twice as much as you're risking. So if you're risking 50 cents, you plan on making $1. And the 1-to-3 is exactly the same thing. You're making 3 times as much as you're risking. You risk 50 cents, you're going to make $1.50. Now let me put this into the terms that may be more valuable to you. Flip it over. What I am saying here is, with a 1-to-3 ratio, you can lose 3 trades and win 1 and be even. Let's say this profit margin is 9 cents. Okay, I'm going to buy 1,000 shares of any stock at any price. It's going to make me $10 for every penny the stock goes up the chart. So this 9-cent profit move is going to make me $90 for every 1,000 shares I have. Now I am risking 3 cents for that 9-cent gain. 1-to-3 ratio, 1/3. If I lose 3 times, that's 3, 6, 9 cents I've lost. If I win 1, I've made 9 cents. So my 1 win cancels out my 3 losses. That's how risk to reward ratios keep your head above water. The very next win is going to put you up. It's going to take another 3 losses to pull you down. Start getting a couple wins under your belt, you start getting a big gap between losses and gains. That's why risk-reward ratios work so well. Now, I have no doubt that your trades are going to improve if you start using R&Rs. But it's important to understand that risk-to-reward ratios are not a hardcore science. The numbers may have to be adjusted in certain cases. I just showed you a trade where I had 9-cent profit and a 3-cent risk. Well, maybe I would have to push that 3 cents to 4 cents because of the way the chart's set up. Let me show you an example. I've got a hot chart here. I like it. I want to get into this because she's about ready to break out. We've got ourselves a 200 squeeze. Our 200-day MA is falling. Our 200 haul is climbing. They're both coming together, pinching the price in the middle, which is on top of the 50 climbing. I want to get into this. So I'm going to get in above the next support over my head. So I'm going to get in right here, about 2 cents up at $2.22. Now I'm going to get out just underneath the next resistance above my head. I never put my trades on these lines. Those are hot spots. That's where the price changes directions and likes to bounce. So I get over top of them and just underneath them. Now I need a stop loss. My stop loss is going to be a percentage of whatever this is, right? My ratio. Now, just for an example, let's say that falls right about there. Is that a good place for it? It fits my risk to reward ratio. Well, when I look over the whole chart, that is not a good stop loss. Look over here, folks, where I've got my arrows. I've got some wicks that have dipped underneath and bounced back up. Got a couple more here. Dipped underneath, bounced back up. If these happen over here and they touch my stop loss, I'm out of the trade and it starts to run. I've missed it. So I've got to take these into consideration. My stop loss has got to be below that line. So I got to get rid of that one there, and I've got to put it at least underneath that one there. I don't want to get hit by a random wick. Now, there's nothing to say it's going to happen, but this is risk management. I am trying to avoid as much risk as I possibly can. So this is the way you might have to set up your chart. You may have to go a little bit further on your stop loss to get it to be a safe place. But again, you're going to have to take all of that into consideration with your calculations. Can you afford that adjustment? So this is how I trade, folks. I use risk to reward ratios. I use supports and resistances. I put all my orders in at the same time so that I don't have to get all freaky during the trade. I let it happen one way or the other. How's that sound to you? Thanks for your time, folks. I hope this opens up your eyes a little bit, and it's not going to hurt you to do some more due diligence. Thanks for your time. And remember, the more you know, the more you're going to grow. See you, folks.